This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. The message in the jobs numbers last month was disappointing and surprising. So President Trump fired the messenger. Does he have a point? And is his approach the right one to make sure we can trust those jobs numbers? Plus, we go to Australia to see the effects of soaring gold prices on mining there and what miners are going to do with all those profits. And we bring you the story of the huge Indian retail derivatives market that got Jane Street into trouble. What does it tell us about the Indian capital markets overall? And what does India's real economy need from those markets? But we start with the continuing battle over the Federal Reserve, as President Trump insists that Governor Lisa Cook must go. And Ms. Cook refuses to leave, even as the president's nominee to replace another governor heads toward Senate confirmation. Our special contributor Larry Summers has consistently expressed his concerns about Fed independence. But so far, the markets have been calm. So, Larry, continued focus on the Federal Reserve as there are proceedings with respect to Governor Cook, Lisa Cook, as President Trump's tried to fire, even as they try to appoint Stephen Myron to come in. What is the significance of what's going on right now with the Federal Reserve?
I think we're on the foothills of a credibility crisis. We're not there yet because people believe that ultimately U.S. institutions endure and succeed. But between the president's demand that interest rates be cut by 3 percentage points, which no economist anywhere has endorsed any idea of that kind, between the harshness of the president's rhetoric vis-a-vis Chairman Powell, between the extraordinary effort to fire a sitting Fed governor with no kind of due process surrounding the for cause provision, between the ominous rhetoric about hijacking the process for choosing local presidents of the regional Federal Reserves, between rumors about other members of the Fed board, we are in completely unprecedented territory. There hasn't yet been a dramatic market reaction. There are some concerning things in markets, not just 1 year ahead, but 1 year ahead. Inflation expectations are trending up a bit. The spread between the 30-year bond and the 10-year bond is larger than any time since COVID. But we haven't seen substantial reactions in markets yet. But this could turn very quickly if the psychology changes. And so, frankly, I think we are playing with fire in terms of inflation expectations, a situation made much worse by the fact that the United States, unless we get a big break in terms of artificial intelligence or other technology, really has a very problematic fiscal picture.
One of the questions some economists have raised is, does it make that much of a difference to have one person on the Fed or two people on the Fed? Part of the strength of the institution is the FOMC is a group of people, and so one or two people alone cannot really change the direction.
That may be right, but what the president is talking about, what he's explicitly scheming about on his Truth Social account and in some of his rhetoric, is getting a majority of the Board of Governors and using that majority on the Board of Governors to force a majority on the Federal Open Market Committee by controlling the appointment of regional feds. So this is not a one and done thing involving just the chairman. This is an attack on the governance of the institution. I'll tell you part of what is really disturbing to me. There have been a long tradition of distinguished Republican leaders who have stood up for the importance of inflation credibility, who have stood up for the independence of the Fed. I particularly admired Senator Pat Toomey when he was on the banking committee for his efforts. But there were others. There was an effort made to deny a nomination when President Obama made it to Nobel Prize winner Peter Diamond because he wasn't steeped enough in monetary policy and respect for the independence of the Federal Reserve. And yet here, when we're talking about the wholesale politicization of the Fed, there is no response from concerned Republicans. And I have to say that I have been struck that the prominent members of the financial community have had more to say being critical of Zoran Mondani's bad ideas about grocery stores in New York than they have the wholesale takeover of the Fed, which is a major threat to the financial system as we have it. So I am very worried that highly irresponsible behaviors are being normalized by what the president is doing and by the failure of the establishment and of the traditional voices to find the courage to resist and call out what President Trump is doing. If disagreements can't be stated openly or asked on or acted on, that's really a very chilling thing.
One of the major driving forces behind the Trump administration in dealing with the Fed is trying to get rates down, particularly things like mortgage rates, rates on car loans. Last time the Fed cut, actually the yield went up. It's expected right now that the Fed is likely to cut this month again. What is the administration's options if, in fact, the Fed does cut this month in September and actually yields go up?
Well, first of all, David, I think you said the important thing. Markets are already pricing in cuts in rates. So if a rate cut is delivered as expected, I would be surprised if that had a substantial impact on long-term rates. I think what markets will be watching is less what happens in September than the signals that are sent with regard to the future. And I think there is a sense that if the Fed is moving towards the president's line, easy rates over everything else, I think the likelihood is that in such an environment, long-term rates would rise and take mortgage rates up with them. That's the kind of pattern we saw with the politicized 1970s Federal Reserve. It's the kind of pattern we avoided during the times of Chairman Volcker and Chairman Greenspan. So I think that's something very much to worry about, and it's why I'm not sure the president is proceeding wisely, even in his own terms, of aspiring towards lower rates that people see. I suppose if long-term rates go up, there are, of course, options to bring back in some form or other the quantitative easing that the president and his people have largely condemned, where the Fed goes in and buys up, or somebody goes in and buys up large quantities of long-term bonds, or in which pressures are applied to banks and pension funds to force them to buy long-term bonds. But if you start down that road, you are really, I think, very severely compromising the integrity of our financial system in ways that will have far-reaching consequences.
Coming up, President Trump claims that the Bureau of Labor Statistics has been misleading the markets with its jobs numbers. What will it take to make sure we have numbers that we can trust? That's next on Wall Street Week. This is a story about trust, maybe the most important thing underlying the markets. Last December, we told you about major problems facing the Bureau of Labor Statistics, the body that publishes those all-important jobs numbers each month. Those problems got much worse when Donald Trump fired the agency's head last month. Our colleague Molly Smith reports on what it could mean for the system and for private businesses looking to get a foot in the door.
In a shared office space in downtown Manhattan, a group of economists see an opportunity.
As you can see, the BLS revisions are quite large.
You might not have heard of Revelio Labs, but they know an awful lot about the U.S. economy. Ben Zweig is the company's CEO.
We're a workforce data company, so we collect data from the public web, so anything that's online. And that could be public professional profiles, online job postings. We gather that data, we curate it, we standardize it, we enrich it, and then we ultimately sell that data.
Revelio's main audience is hedge funds and private firms looking for another perspective on the economy, beyond what's offered by government agencies. But things changed after an ugly July jobs report.
We got a very disappointing number here, and this is going to get Wall Street's attention. 73,000 jobs created.
President Donald Trump claimed, without evidence, that the numbers were biased and ousted the head of the Bureau of Labor Statistics.
I believe the numbers were phony, just like they were before the election, and there were other times. So you know what I did? I fired her. And you know what? I did the right thing. We need people that we can trust.
We were really, really shocked when this happened. This happened on Jobs Friday, of course. And then over the weekend, I remember making some calls. I called our chief economist and a few other people on the team, and we were all kind of thinking the same thing. We were like, all right, we gotta publish macro statistics. There's some concern that the BLS may become politicized, either institutionally or just through the incentives they face. Maybe there's some concern that whoever leads it gets the message that if the numbers don't match a certain narrative, they might be out of a job. So there are some distorted incentives, and there's some concern that this data might not be trusted in the way that it has been, and it's time for us to step up.
There's nothing to report that says that there's been actual political interference. Now, I know there was a charge, and that was the reason for the firing, that the data for the revisions were politically manipulated. And that is absolutely 100% untrue.
Mike Horrigan is president of the Upjohn Institute, a think tank focused on labor markets. He also spent over 30 years at the BLS, at one point leading the Employment Statistics Division.
I've served under many commissioners, whether they be nominated by a Republican president or a Democratic president. I got to say, all of my experiences while I was at the Bureau was that of collaboration, collegiality, understanding. I personally think all the business leaders I talk to still have trust in it. I think what they're looking for is whether or not a new commissioner is going to come in and interfere with that trust. I think that's the next big test.
After ousting Erica McIntyre, President Trump tapped E.J. Antoni to head up the Bureau of Labor Statistics. Antoni is the chief economist at the Heritage Foundation, a conservative think tank, and was a contributor to the controversial Project 2025 plan. He faces Senate confirmation before he can step into the new role at BLS. We spoke with former Commissioner Bill Beach about the politics of the role. Beach served under both President Trump and Biden.
Whether the president's Republican or Democrat, they're going to find someone who has maybe demonstrated, or at least could demonstrate, that they support the general drift of the policy portfolio the president has laid out. So EJ definitely qualifies on that.
So E.J. Antoni has been pretty vocal about his critiques of BLS, including the jobs data, the revisions. He suggested before he was named to the role that the BLS should suspend the monthly jobs report until the data issues are, quote, corrected. Do you think that that's a viable solution for a problem that BLS is facing?
It's not viable at all. The monthly reports coming out of BLS, particularly the jobs report, are watched by financial movers and shakers all over the world, by policy people all over the world. Their biggest impact is here in this country, and I can't imagine a situation more deleterious to the economy that a statistical agency could do than to suspend or stop or delay one of their reports. I mean, it would cause a lot of problems. So no, it's not viable. And I think EJ will quickly see that if he's confirmed.
One report suggests Antony has since backed off from the idea of suspending the monthly jobs report. But regardless of whether Trump's new BLS chief makes the agency better or worse, the issue remains that there's room for improvement. The agency's problems are twofold: the budget needed to get the numbers right, and the people to make sense of those numbers. Its resources haven't kept up with the scope of the challenge it faces. Adjusted for inflation, BLS funding has slumped about 20% since 2010, and President Trump's fiscal 2026 budget proposal would shave off an additional 8%. But Horrigan says that the BLS has already been making the most of its tight budget.
The Bureau gets about 58% of their reports now from this thing called EDI. So, for example, with Internet, where it's more like a single firm or a smaller firm will go into the Internet or the web data collection facility and enter their answers into that format, that's probably about 20 to 25% of the sample. There are other forms in which the data are collected. So, for example, CADI is a computer-assisted telephone interview. So a lot of these innovations were introduced well before I came on board, but over its history, those different innovative data collection techniques have been increasing over time.
Changes in the BLS's methods of collecting data wouldn't be without precedent. Its statistical peer, the Census Bureau, is already working with private partners to get creative in its data collection.
In terms of that next step, I mean, that's really kind of a function of resources. Census Bureau, for example, is doing some innovative research right now with Intel and Amazon to take a look at how you could use the firm's data in its own format and then use a large language model to basically fill out a survey form. That's the kind of innovative thinking that the Bureau and CES have done for years, and with more resources, they would be capable of doing that kind of innovation.
Innovation at the agency can also come through changing processes that no longer work as well as they once did. Nancy Potok was the chief statistician of the U.S. at the Office of Management and Budget and is currently CEO of NAPEX Consulting.
There's no question that we need improvement, we need investment, we need more research, and we need to update methodologies. The agencies have been starved of resources for a long time. I think a healthy discussion within the administration is a great thing. I'd love to see it. And I think it should involve people outside the system as well, the users. People who are really relying on the numbers to make decisions need to provide input into that, as well as methodologists.
I'm not telling the Bureau what to do, but they collect the data through the Friday before the release of the data on Employment Situation Day. So one option to consider is, if you want more reports coming in, before you introduce any additional innovation in terms of data collection techniques, maybe consider extending the time period for that first closing.
But processes and innovative partnerships need people to shepherd them, people it's been losing. The agency has roughly 2,000 employees, and a third of its top positions are now vacant.
One of the concerns I have is, even if you throw more resources at a time when we've lost so many talented members of the statistical community because of the fork in the road, because of firing all the folks that have less than 2 years of tenure, and all the senior executives that have decided to retire, you've got a people problem.
It's just amazing looking at the magnitude here. These are the green ones, again, BLS, and the blue ones are yours.
Pretty much what you get the first time is going to be very close to what you get a month later and a month after that.
The private sector thinks it can lend a hand to solve the government's data problem.
An idea that's come up in the context of improving federal statistics is this idea of blended data. So incorporating private or alternative data sources on top of what the government collects. Is that something that you have explored with BLS or other statistical agencies, or something you want to do?
Yeah, I mean, we would love to do that. It hasn't come up. No one has asked us if we'd like to.
Would you ask them?
Yeah, I think so. I mean, I think they know about us. We're very much in the same circles. It's a small world of labor economists, and we all know each other. And I think, certainly within financial markets, we're well known as the kind of go-to source for labor market information. So I think they know that we're doing this. My sense, and granted, I'm not in the room when these discussions happen, is that the BLS has not been able to justify funding for these new initiatives. And they've had their funding cut again and again. And this is something like a wish that has never really, gotten traction. So not holding my breath for it. And I'd love if it would happen. In the meantime, we're just going to put it out there as a public service.
The science of statistics is empirical, but under the hard data lies the immeasurable but important quality of trust in those numbers and in the entities responsible for collecting and reporting them.
This is not a trivial matter. The trust in BLS is connected to trust in their product. The two are the same. And if you don't trust the product, then, for example, you're making a big merger with another company and you use data from BLS, and it has to be pretty believable in order for your hurdle rates for the investment to be believable. Well, now you don't quite believe it, so you begin to hedge a little bit more uncertainty around that hurdle rate than there was before. And uncertainty produces higher costs in the acquisition process. I'm using a very small slice, but that's repeated every day thousands of times. So I think losing trust in a bedrock institution is highly consequential, highly difficult, and very expensive for an economy. Does it reduce the growth rate? Yes, over time it could actually reduce the growth rate in the economy. Not to know the economy is operating at a certain level because you distrust the data means you don't know how the economy is operating. And how can you function efficiently and use your resources at their highest and best use if you really can't see the economy the way you think you should?
Nancy Podock says that today, as Trump's BLS pick prepares for the Senate confirmation process, the country sits at a crossroads. Will leadership continue to prioritize the best, most impartial data, or will it fall into a familiar trap that other countries know too well, in which numbers aren't used to learn about the economy, but to tell an approved story about it?
We really need people to get excited about the whole system, not just the firing of the BLS commissioner, but knowing that that's a keystone in a larger system that is in peril. We're going to go one way or the other at this point. I don't think there's a status quo option. I think it's either going to get very political or people are going to really strengthen the system. We've got to choose as a nation which way we're going to go.
Up next, there's gold in them thar Australian outback mines, and firms are reaping the benefits from higher gold prices. But what are they going to do with all that money? This is a story about money burning a hole in your pocket. The price of gold has been on a rocket ride up. Our colleague Paul Allen tells us about what this means for gold mining in Australia and both the risks and the opportunities.
In the Australian outback, scrub and red dust stretch as far as the eye can see. It's desolate out here and it's dry. But beneath the dust, there's a bounty that miners are willing to dig a long way for.
How many ounces of gold would be in a typical truck?
So there'd be around 500 grams of gold in a truck.
So we've got a line of trucks slowly making their way out of the pit here. How long does it take to get from the bottom to the top?
Yeah, it's well over an hour.
The Kalgoorlie Super Pit in Western Australia is a sight to behold. More than 600 metres deep, it would cover even Manhattan's tallest skyscrapers. It's so vast, it'd swallow Central Park.
this project's going to be an important one for our business and our shareholders. It's over half.
Stuart Tonkin is CEO of Northern Star, Australia's biggest gold miner.
Probably around $300 to $400 million per annum being spent moving material from the southern part of this pit, gaining access to over 6 million ounces of gold in the bottom of this southern part of this pit.
The price of gold has been on a tear. It's up nearly tenfold since 2000 and more than doubling over the last 5 years. Tonkin's company and many others around Kalgoorlie are cashing in, but the gold industry has been here before.
There's probably more failure stories than success stories where people can point to in the gold sector. And so repairing a lot of that trust with investors as we go into another cycle has been really important for our company, and I think for many Australian companies to get that investor trust.
But before we get to that, let's set the scene. It was 1893 when a group of prospectors on horseback quite literally struck gold in Kalgoorlie. A rush ensued and the precious metal has dominated the Western Australian town of 30,000 ever since. Ashok Parekh is the local accountant and chairman of mid-tier gold producer Horizon Minerals.
I've been involved in the mining industry for over 40 years in Kalgoorlie, and I happen to own a pub as well. When I came here, gold was probably $150 an ounce. Today it's over $5,000 an ounce. It has been great for everybody in Australia. At Kalgoorlie, we're the biggest gold mining town others in Australia. And Kalgoorlie is different. You can come to Kalgoorlie, you can walk into a pub, you got no job, nowhere to live, and no money. And by the time you walk out, you've had a meal, you've got a place to stay, and you've got a job.
And there's plenty more people finding jobs and places to mine, with the price of gold booming.
We're currently mining this ore in a great gold price environment. What these high gold prices do for us is we can actually produce gold now, pay a little more through processing through third-party infrastructure, so use other people's infrastructure. But what it does is it actually closes that funding gap we'll need to refurbish our own plants.
I call them pop-up shops around the goldfields here, just the amount of flurry and activity of things that weren't economic 6 months ago that suddenly become economic.
Australia produces about 300 tonnes of gold each year. That's about 8% of global production. It's a costly exercise. The process involves breaking down vast amounts of ore extracted from the mine. Each truck can carry about 250 tonnes of material, but just typically 500 grams of that is gold. That material's then broken down and processed by crushers before being melted.
So the melting point of gold is 1,024 degrees. So we then heat the furnace up to roughly 1,200 degrees. As we go through the pour process, the first material comes out is all of that slag off the top of the crucible. Then when the gold comes out, the colour change actually goes from a yellow almost to a greeny colour, and that's the gold coming out of the process. Probably one of the good things about this site is that we have a relatively nice ore body coming into it. We don't have a great deal of impurities coming through, so these are some of the nicest bars that I've seen in my time in industry.
And with a surge in prices, Australia's gold miners are cashing in and setting themselves up for long-term success. Laurie Conway is CEO of Evolution Mining.
So back in June 23, we made the decision to invest $250 million building this plant expansion and $75 million to open up a new mining centre into the north here to feed the plant, taking it from 2 million tonnes to 4.2 million tonnes. And in 23, it was pretty difficult. The market was hot, it was hard to get people, hard to get equipment. I think we were very fortunate when we did that, but gold price was only $2,400, $2,500 an ounce when the board approved this, and it had very good economics. I mean, bringing it in right now at $5,000, $5,200 an ounce is a perfect time to be commissioning it.
I think that the difference this time is what's going on around central banks and that shift of we need to have gold in our reserves a lot more, whereas back in the last cycle it was really around the whole mining boom and therefore what was going on in low inflation, low interest rates that pushed the price of gold up, and so that was more being driven by an economic standpoint. This time it's really being driven by geopolitical tensions and the shift in the way that governments are handling their reserves, and so that's why you sort of see that structural shift that the governments are driving this price, whereas the economy was driving the other one. And that's why, in the long term, yes, the gold price will come down a bit, but it's structurally shifted higher because of what central banks are doing versus the last boom.
In 2019, Evolution reported adjusted gross profit of about $270 million US, or about 410 million Australian dollars. That's now jumped to about 1 billion. It's expected to grow even further to almost 2 billion next year.
And how are you about on the costs front? What's that like at the moment?
Power will go up because we're obviously doubling the processing, and the processing uses power. 50% of our costs are labour.
And investors are keeping a keen eye on costs this time around. When gold prices last jumped, Australia's gold miners underperformed, falling 16% in the 3 years from 2010, while the price of the metal itself rose 52%. Kate McCutcheon covers Australia's gold miners for Citi.
So last cycle, we definitely saw a lot of transformative M&A, which was very value destructive. So that last cycle from 2000 to 2012, the 10 biggest gold stocks in our coverage universe cumulatively burnt $10 billion in free cash.
As an industry, we made those missteps because when the price did come off and that cycle changed, shareholders went, well, where's the cash? And all the industry said is, well, we reinvested it into projects, or we went and bought assets, and therefore we've reinvested that money for you. And the shareholders were like, well, we would have liked some of that, and we didn't see that. It hasn't changed too much, other than that we're putting more cash in the bank, which is what our shareholders want to see.
So it's interesting you say you've got more cash in the bank. Has this changed your approach to reserve management and long-term planning as well?
You've got to see it as a sustained price at these levels before, because you can't just change your mine plans overnight. So what it does mean, we look at our reserve pricing, we look at what the costs have changed, because you do see costs generally follow the gold price. And then we look at, what projects become more economic in a higher price environment, and then we apply the normal discipline of when do you bring those on.
Look, I think it's important that you look at a lot of these things in hindsight. Some things like hedging, hedge book legacy, at prices that people had never thought that they would see exposure to. When people had a high equity price, they probably tried to use that currency by raising lots of money on the back of an elevated equity price, and then potentially dropping money out of their balance sheet, returned capital to shareholders that then wasn't retained for its own sustainability inside the business. So there are very many different disciplines of what people do at different times.
And do you feel lessons have been learned? Do you feel like the approach is different this time?
I feel that the heat has come out of some of that, but I've found a foundation discipline of true capital management across a variety of things. So, dividend paying gold companies was never really heard of. There's a lot of good track record of gold companies paying dividends, doing share buybacks, compressing registers that they had raised equity on the back of. Those are the type of capital management measures that aren't typical to a gold company.
This time, investors want to see more tuck-in acquisitions or bolt-on acquisitions close to infrastructure. It's very, very hard in a bull gold market to do a deal that's accretive, and I think the gold companies are realising that. Secondly, what's not different this time is delivery on operational guidance. So the three biggest stocks in our coverage universe, Evolution, Northern Star and Newmont, actually up until this FY hadn't delivered on guidance for between 4 to 7 years. The third thing that's different this cycle is also hedge books. So now we're seeing gold miners opt for no hedging policy, so that exposure to spot prices, and putting in place some put options to protect the downside. And this cycle as well, most of the gold miners in our coverage are in a net cash position or running at peak net debt of 15%. So balance sheets are very different this time.
And investors appear to be liking what they're seeing. Since the start of 2022, the gold price is up 85%. Australia's gold miners are up 98%, with both Northern Star and Evolution balancing share buyback programs with new investments in recent months.
Do you feel like investors now buy the idea that the gold industry is more disciplined than it has been in the past?
Yeah, I think if we can continue that over the next sort of 12, 18 months through, increasing dividends, making sure that, some companies do buybacks, that they do see that, as well as reinvesting in the business, because the shareholders still want us to reinvest in the business. They want us to make it sustainable over the long term, but they do want to share in that as we're going through this cycle.
Just spent a couple of weeks in the US meeting with investors because there's a lot more interest in the US in Australian gold stocks at the moment, and so it was good to go and talk to them and explain what we're doing here at Evolution, but also what the gold industry in Australia is doing, and there's certainly going to be more interest.
The big question is, where to next? Gold has plateaued in recent months, but in an increasingly uncertain macro environment, is there room to go higher?
It's a really exciting time for gold, and it's been elevated for some time, but there doesn't seem any signs that this is going to fall back. We think it's possibly the new norm, and if anything, the start of another continuing bull run for gold.
Yeah, certainly. I mean, gold started back in the 1850s, so it's been around and been a part of Australia for a very long time. And I think, as we go through the boom and bust of economies, gold has had a significant role to play. It now has a more important role to play because we are a top 10 producer, we're a low-cost producer, we're a great jurisdiction in which to operate, and therefore it makes it important to the Australian economy, but it also means it makes it attractive for people to invest in the sector.
Whether it does make it attractive for people to invest in is going to depend on some big decisions being made by companies like Evolution and Northern Star. Is it time to double down on the gold mining bet, or is it time to take some money off the table and give it back to investors?
Coming up, millions of Indians put billions of dollars into equity derivatives and lost most of it. We take a look at Indian capital markets and their role in driving growth and innovation. That's next on Wall Street Week. This is a story about walking a tightrope. India Prime Minister Modi is committed to making India an economic power, and capital markets are what provide businesses with the money they need to start and to grow. But to do that, they need to encourage investors to take risks, enough risk, but not too much, a fine balance we recently saw lost in India's equity derivatives market. As a market maker with a unique model, Jane Street's business makes bets on inefficiencies in markets. Bloomberg reporter Catherine Doherty has been reporting on its business in India.
Jane Street has kept its trading secrets close to their chest, but it was really the Millennium lawsuit.
Jane Street saw an opportunity in India's equity markets, engaging in a strategy called index arbitrage.
So the firm was essentially placing these large bets that were then impacting the other side, and they were profiting from the way that these markets were moving. So the regulators in India have identified this as a manipulative trade, and the firm has said it was an arbitrage trade and not market manipulation.
India's market regulator, the Securities and Exchange Board of India, or SEBI, banned Jane Street from the country's securities markets. Jane Street has filed an appeal alleging that SEBI denied it access to documents it needs to defend against market manipulation accusations. Ironically, the problem with India's capital markets historically has not been encouraging too much risk, but too little. Nilesh Shah has watched the evolution of the country's capital markets as the managing director of Kotak Mahindra Asset Management.
The Indian savings allocation is more tilted towards physical assets. We are one of the largest buyers of gold in the world, putting anywhere between $50 to $70 billion annually. We also have love for real estate. Capital market or financial savings itself has taken off in recent times. But thanks to mutual funds, insurance industry and pension funds, slowly and steadily allocation to capital markets, both debt and equity, is increasing rapidly.
India's transition to retail investing is still in its early stages, but it is moving fast. 1 in 5 households today hold shares, up from 1 in 14 just 5 years ago.
We launched an investor awareness program called Mutual Funds Sahi Hai. Mutual funds are right thing to do. And that has helped us in mobilizing more and more retail savings into mutual fund. Our industry is growing at a frenetic pace, and I believe the nudges from the regulator, the work done by the regulator, is laying the foundation. Now it is up to us as an industry to carry forward the work.
One measure of the expansion of Indian capital markets is the success of its IPO market, which is among the biggest in the world.
Last year, IPOs in India accounted for about more than $20 billion US dollars. It was the number 2 IPO market in the entire world.
Josh Fellman is the principal at JH Consulting and advised the Indian government on economic and financial matters during his time as the director of the IMF's India office. To date, regulators have encouraged retail participation in IPOs, helping contribute to overall retail participation in markets.
One thing that they've been fantastically successful in, as opposed to, say, China, is they've managed to get household participation in the capital markets.
It's not all roses. Under the surface of India's blossoming capital markets is a risk that threatens its stability: derivatives.
About 40% of derivative transactions are conducted by households in India, which is an incredibly large number. So if you take the derivatives market in particular, the regulator, SEBI, did a study. They found that last year, about 90% of the participants in the market lost money. And they found that, again, about 40% of them were under 30. 3/4 of them earned less than $6,000 per year.
The growth in derivatives has caused a liquidity problem.
It is a fact that there are a large number of unsophisticated investors. It is a fact that they have very poor cash buffers. But what to do about it? You don't want to push these people completely out of the market. On the same time, you don't want to unduly restrict the professional participants in the market, because they're the ones who iron out the market inefficiencies. So far, it has not had any adverse impact on the ability to raise money through the equity market.
Even if the illiquidity in markets hasn't affected raising capital to date, it has introduced a different kind of risk.
So in India, the options market is quite liquid, the most liquid active market really across the globe. In the US, you also have a very liquid options market, but the cash market, the equity market, is also liquid. It's also trading at high volumes and it's moving very efficiently, and the regulators really have a sense of the big players, and if there's any manipulation or if there's any large moves, they're able to identify it very quickly.
India's financial regulator, SEBI, has made an example out of Jane Street and drawn a boundary in how far it's willing to go to liberalize its markets. But keeping the door open to foreign investors will be crucial for the country.
India is one of the most open economy in terms of foreign direct investment. India's largest FMCG company, automobile company, telecom company, mutual fund, private sector bank, insurance company, all are majority owned by foreigners. There is hardly any other country in the world where foreigners will be allowed to own such kind of industry. However, can we improve further upon this? My favorite example on foreign direct investment is Maruti Suzuki. In the 80s, Suzuki came to set up an automobile company in India. They have gone through the ups and downs of India. Today, Maruti Suzuki, a 53% owned subsidiary of Suzuki, sells more automobiles in India than what Suzuki sells worldwide. And Maruti has delivered better return than Suzuki, Honda, Toyota combined in the equity market since its listing in 2003.
It isn't just equity markets that provide capital to companies, and the debt side of the capital market equation may be about to get a shot in the arm when Indian government bonds are included in several FTSE Russell bond indexes this month.
Essentially, we have seen that whenever a country becomes part of benchmark indices, both passive as well as active flow starts flowing in. So inclusion in FTSE government bond indices will undoubtedly increase allocation towards India. More importantly, when you get an alternate source of funding, for example, all domestic investors are generally on one side of liquidity. Either it's high or it is low. but global investors can bring balancing part.
Indian markets have come a long way in encouraging risk-taking among retail investors and offering channels of investment to foreign investors. But Shah says that hasn't been enough to support the risks inherent in generating the kind of innovation that comes from the success and failures of startups.
Unfortunately, here Indian capital market has not done a good job. Majority of our startups, both innovation as well as otherwise, have been funded by global private equity and venture capital funds. It has been to some extent funded by family offices and high net worth individuals. Like the public market, private market has not received encouraging participation from Indian capital. The second thing is related to instruments. The private equity market, unlisted market is not as much regulated as the public market is. So the domestic flows, domestic retail flows have not moved into unlisted segment as much as it should have done. The third, and probably which is changing rapidly, is creation of angel networks. The whole purpose of venture capital industry is to some extent go from monkey to King Kong scenario. You invest in lots of monkeys, some of them will grow to become gorilla, and one of them will eventually become King Kong.
There was a lot of financing through venture capital, through private equity for Indian startups. People wanted to bring the sort of IT ecosystem that exists in the United States into India. So, for example, food delivery firms, which has proved to be an enormously big and very successful market in India. Ride-hailing apps. All these things have been started in India and have proved very successful. A lot of them have firms have grown and exited through the PE firms have exited through IPOs. But of course, more recently, as elsewhere, when interest rates moved off the zero level, a lot of that financing has dried up.
Whether it's reforming taxes on securities transactions, or limiting speculation in cash equities and derivative markets, or making sure both debt and equities are supporting innovative new companies, India is moving, trying to walk that tightrope of risk and stability to support its economic growth. And its very motion means that it can't come to a rest. That does it for us here at Wall Street Week. I'm David Westin. See you next week for more stories of capitalism.